My name is Julie Asti. I'm a certified financial planner with Asti Financial Management, and today I'm going to talk about how to buy your first investment property. If you want to buy an investment property, one of the first things that you're going to want to think about is if you're going to want to manage the property or if you're going to want to have a property manager. There have actually been a lot of investors who have gotten into investment property only to find out they absolutely hate being a landlord. You can still certainly own investment property and not be a landlord, but you're going to have to be willing to pay a property manager. Normal rates are about 10% of the monthly rent or cash flow that's coming from the property is going to be the property management fee. So you have to take into account that there would be a fee if you don't want to actually be a landlord and deal with maintenance and collecting the rents and dealing with qualifying tenants and making sure that the building is occupied. So that's one of the first things that you're going to want to do. Really, the next thing, which is the biggest key to the entire equation, is to make sure that you really do your research. Not only research in terms of the type of property you want to own, a duplex, a fourplex, a multi-unit, single-family home, what type of property, what the price of the property is that you would be looking at, and you definitely want to look for location, and of course you're going to want to be looking for upside potential. So there's really a lot of research that needs to go into finding the right property that's going to fit for your specific situation. After you find a property, you're going to want to really, get out your pencil and sharpen it and kind of start crunching some numbers, because you're going to ideally want to find a property that's going to be at least at break even, if not cash flow positive. And sometimes in certain environments where property values are very high, interest rates on loans may possibly be high, you really want to break down and crunch the numbers to make sure that the rents that are going to be coming in are going to be able to take into account and pay for property management, expenses, maintenance, insurance, the mortgage, any other expenses, travel expenses, any other administrative expenses that you may have associated with the property. If the building has very good upside potential and it's looking like it may appreciate in a few years, sometimes buyers will go into a property and actually take a cash flow that's negative because they figure that in a few years they can either refinance the loan based on the property value, or that the property value will be increasing over time that will make the property turn out to be a good deal. And the last thing that you're going to want to take a look at are really the lending and the funding requirements, because it is different than a primary residence. The rates are going to be a little bit higher, the loan terms may be a little bit different, and for most rental properties, lenders require a solid 20% down. There's just no 0% or 10% down. There's usually going to be a 20% down payment requirement. So you're going to want to make sure you're working with a good mortgage broker to find out a loan package that's going to work for you and that you can meet the lending requirements. My name is Julie Asti. I'm a certified financial planner with Asti Financial Management, and you can learn more about my company or my services online at www.astifinancial.com.